Hello, and welcome back. Today, we embark on a journey towards securing your financial future. We'll be navigating the dynamic world of Indian investments, exploring avenues like stocks, mutual funds, ETFs, and much more. Whether you dream of owning a home, funding your child's education, or retiring comfortably, smart investing is your roadmap to success. In India, a plethora of investment opportunities awaits. Each instrument carries its own risk and reward profile, requiring careful consideration and strategic decision-making. Get ready to gain valuable insights, learn the nuances of each investment option, and empower yourself to make informed financial choices. Your journey towards financial freedom starts now. Now, let's address a crucial point. Why investing is non-negotiable in today's world. Imagine this. You diligently save a portion of your earnings every month, placing it securely in your bank account. While saving is a commendable habit, there's a silent adversary at play: inflation. Inflation is the rate at which prices for goods and services rise over time, effectively eroding the purchasing power of your hard-earned money. Let's say you earn a 4% interest rate on your savings account. But what if the current inflation rate is 6%? This means that while your money is growing, the cost of living is increasing at a faster pace. This is where the power of investing comes into play. Investing, unlike traditional saving, provides an avenue for your money to outpace inflation and generate substantial returns. It's about putting your money to work for you, allowing it to grow exponentially over time. Think of investing as planting a seed. With careful nurturing, that seed has the potential to grow into a mighty tree, bearing fruits for years to come. Similarly, your investments, when chosen wisely, can flourish and secure your financial well-being. India offers a diverse array of investment instruments, each catering to different risk appetites and financial goals. Whether you're a seasoned investor or just starting, understanding these options is vital. Investing is not about getting rich-quick schemes. It's a long-term strategy that requires patience, discipline, and a sound understanding of the market. Stay tuned as we unlock the world of stocks, mutual funds, ETFs, and more, paving your path to financial success. Now, let's dive into the exciting world of stocks. Imagine owning a tiny piece of a giant corporation like Reliance Industries or Tata Motors. That's precisely what you do when you invest in stocks. In essence, a stock represents a unit of ownership in a publicly listed company. When you buy a stock, you become a shareholder, entitled to a portion of the company's profits and voting rights in key decisions. India boasts two primary stock exchanges: the Bombay Stock Exchange, BSE, and the National Stock Exchange, NSE. These bustling marketplaces facilitate the buying and selling of stocks, connecting investors like you to a vast array of listed companies. The price of a stock fluctuates constantly, reflecting the collective sentiment of the market. The beauty and the challenge of the stock market lie in its inherent volatility. Stock prices are like restless waves, constantly ebbing and flowing, influenced by a myriad of factors. Company performance is a key driver. Positive earnings reports, innovative product launches, or strategic acquisitions can send stock prices soaring. Conversely, disappointing financial results, regulatory hurdles, or industry downturns can trigger a decline. Macroeconomic factors also play a significant role. Interest rate changes, inflation figures, government policies, and global economic events can all impact investor sentiment and, consequently, stock prices. The potential for substantial returns exists, but so does the possibility of losses. Understanding these dynamics is crucial for navigating the stock market effectively. The Indian stock market is a vibrant tapestry, woven with threads of diverse industries and companies, each with its own story to tell. From blue-chip giants to nimble startups, the options for investors are vast and varied. Blue-chip companies, often household names like Reliance Industries, HDFC Bank, and Infosys, represent established players with a proven track record of profitability and stability. These companies are often considered less risky, but may offer moderate growth potential. Mid-cap and small-cap companies, on the other hand, represent emerging players with significant growth potential. While riskier than their blue-chip counterparts, these companies can offer substantial returns if they capitalize on their growth opportunities. Analyzing a company's financial health, understanding its business model, and assessing its future prospects are crucial steps before making any investment decisions. Weighing the scales, advantages, and disadvantages of stock investments. Like any investment avenue, stocks come with their own set of advantages and disadvantages. Understanding these is essential for making informed decisions aligned with your financial goals and risk appetite. Let's start with the positives. Stocks offer the potential for high returns, outpacing traditional investment options like fixed deposits. Over the long term, the stock market has historically trended upwards, rewarding patient investors. Moreover, owning stocks provides a sense of ownership in a company. You become part of their growth story, sharing in their successes. Some companies also offer dividends, distributing a portion of their profits to shareholders, providing a regular income stream. However, it's essential to acknowledge the risks. Stock markets are inherently volatile. Prices can fluctuate significantly, leading to potential losses, especially in the short term. Economic downturns, geopolitical events, and regulatory changes can all impact stock prices, sometimes dramatically. Decoding mutual funds, your gateway to diversified investments. Now, let's venture into the realm of mutual funds, an investment avenue that has gained immense popularity in India. Imagine a basket filled with a variety of fruits, each representing a different company's stock or bond. That's the essence of a mutual fund, a diversified portfolio of assets managed by professionals. Instead of putting all your eggs in one basket by investing in a single stock, mutual funds allow you to spread your risk across multiple securities. This diversification acts as a safety net, cushioning your portfolio against the volatile swings of the stock market. Multiple investors, big and small, pool their money together, forming a large investment corpus. This corpus is then entrusted to professional fund managers who use their expertise to invest in a predefined portfolio of assets. In India, mutual funds are regulated by the Securities and Exchange Board of India, SEBI, ensuring transparency and investor protection. Navigating the mutual fund universe, types and categories. The world of mutual funds is vast and varied, offering a plethora of options to suit different risk appetites and investment goals. Understanding these categories is crucial for choosing funds that align with your financial aspirations. Equity funds, as the name suggests, primarily invest in stocks. They offer the potential for high returns, but also come with higher risk. These funds are suitable for investors with a long-term investment horizon and a higher risk tolerance. Debt funds, on the other hand, invest in fixed income securities like government bonds, corporate bonds, and treasury bills. These funds are considered relatively safer than equity funds, offering stable returns with lower volatility. Balanced funds, as the name implies, strike a balance between equity and debt investments. They offer a mix of growth potential and stability, making them suitable for investors seeking moderate returns with moderate risk. The power of professional management. Fund managers at the helm. One of the key advantages of investing in mutual funds is the expertise of professional fund managers. Think of them as experienced captains navigating the ship of your investments through the choppy waters of the market. Fund managers possess in-depth market knowledge, analytical skills, and years of experience in managing investments. They conduct thorough research, analyze market trends, and make informed decisions on buying and selling securities to maximize returns for investors. They actively manage the fund's portfolio, rebalance assets periodically, and adjust investment strategies based on market conditions to ensure alignment with the fund's objectives. While fund managers play a crucial role in driving returns, it's important to remember that past performance is not indicative of future results. Weighing the pros and cons, making informed mutual fund decisions. As with any investment avenue, mutual funds come with their own set of advantages and disadvantages. Understanding these is essential for making informed decisions aligned with your financial goals and risk tolerance. On the plus side, mutual funds offer unparalleled diversification, spreading your risk across a basket of assets rather than a single stock or bond. This diversification helps mitigate losses and provides a smoother investment journey. Moreover, mutual funds provide access to professional management. Fund managers bring their expertise to the table, making investment decisions on your behalf and actively managing the fund's portfolio. This is particularly beneficial for investors who lack the time or expertise to manage their investments directly. However, it's crucial to acknowledge the costs associated with mutual funds. Fund houses charge expense ratios, which cover the costs of managing the fund, including fund manager fees, administrative expenses, and marketing costs. Entering the ETF arena, a hybrid investment approach. Let's now turn our attention to exchange-traded funds, commonly known as ETFs. Imagine a bridge connecting the world of stocks and mutual funds, offering the best of both worlds. That's the essence of ETFs, a hybrid investment vehicle that combines the diversification benefits of mutual funds with the flexibility of trading stocks. Like mutual funds, ETFs pool money from multiple investors to invest in a diversified basket of assets, such as stocks, bonds, or commodities. However, unlike traditional mutual funds, ETFs are listed and traded on stock exchanges, just like individual stocks. This key distinction empowers investors with real-time pricing and the flexibility to buy or sell their ETF units throughout the trading day at market prices. They offer investors a convenient way to track specific market indices, sectors, or themes, providing exposure to a diversified portfolio of assets with relative ease. Tracking the market pulse ETFs and index investing. ETFs in index investing replicate market indices like Nifty 50 or Sensex. They invest in a basket of stocks representing a market segment. This provides broad market exposure and participation in economic growth. It eliminates extensive stock picking and research. Plus, index ETFs have lower expense ratios. ETFs versus mutual funds. Deciphering the differences. ETFs and mutual funds share similarities in diversification and management, but key distinctions exist. ETFs trade on stock exchanges, allowing intraday buying and selling. This offers flexibility and control over timing. Mutual funds trade based on NAV, calculated at day's end. ETFs generally have lower expense ratios, but involve brokerage fees. Understanding bonds, lending for returns. Bonds are the quieter, more stable cousins of stocks. A bond is a loan you provide to a borrower, like the government or a corporation. It's like lending money to a friend who promises to pay you back with interest. You get regular interest payments and the principal back at maturity. In India, bonds are crucial for funding projects and operations. Bonds offer stable investment options with predictable income streams. Section 2. Government bonds. The pillars of stability. Government bonds, also known as GSECs in India, are considered one of the safest investment avenues available. Imagine lending money to the government, backed by the entire nation's resources. That's the level of security government bonds offer. These bonds are issued by the Reserve Bank of India on behalf of the government to raise funds for various public sector projects and initiatives. They come with a fixed interest rate and maturity date, providing investors with predictable returns over the bond's tenure. Government bonds are particularly attractive to risk-averse investors seeking capital preservation and steady income. They are considered relatively immune to market volatility, providing a safe haven during economic uncertainties. Moreover, government bonds offer tax benefits under certain schemes, making them an even more attractive investment proposition. For investors seeking stability, regular income, and tax efficiency, government bonds are a compelling choice. Section 3. Corporate bonds, balancing risk and reward. While government bonds offer unparalleled safety, corporate bonds introduce an element of risk, albeit with the potential for higher returns. Imagine lending money to a company, knowing that their ability to repay depends on their business performance. Corporate bonds are debt securities issued by companies to raise capital for expansion, acquisitions, or other business needs. They typically offer higher interest rates compared to government bonds to compensate investors for the additional risk involved. The creditworthiness of the issuing company is a crucial factor to consider when investing in corporate bonds. Credit rating agencies assess the financial health of companies and assign ratings to their bonds, indicating their ability to repay their debt obligations. Higher-rated bonds are considered less risky but may offer lower interest rates, while lower-rated bonds carry higher risk but may offer more attractive returns. Investors need to carefully evaluate the risk-reward trade-off based on their investment goals and risk appetite. Section 1. Beyond the usual suspects. Exploring alternative avenues. While stocks, mutual funds, ETFs, and bonds form the bedrock of a diversified investment portfolio, India offers a plethora of alternative investment avenues, each catering to specific financial goals and risk appetites. Let's start with fixed deposits, or FDs, a staple in the Indian investment landscape. FDs are like safe havens, offering guaranteed returns over a fixed tenure. You deposit a lump sum with a bank or financial institution for a predetermined period, earning interest at a fixed rate. While FDs provide stability and capital protection, their returns may not always outpace inflation, especially in a high inflationary environment. Next, we have the Public Provident Fund, or PPF, a government-backed savings scheme designed for long-term wealth creation, particularly retirement planning. PPF offers attractive tax benefits, with contributions, interest earned, and maturity proceeds all enjoying tax-free status. While PPF offers stability and tax efficiency, its long lock-in period of 15 years may not suit investors seeking short-term liquidity. Choosing the path that aligns with your goals. Gold holds a special place in the Indian psyche and investment portfolio. It's seen as a hedge against inflation and a symbol of wealth. Invest in gold through physical gold or financial instruments like gold ETFs. Real estate is a tangible asset class favored by Indian investors. It involves purchasing land or property for personal use or rental income. Each investment avenue comes with its own set of risks and rewards. Navigating the investment landscape with confidence. The power to shape your financial future lies within your grasp. Craft a personalized roadmap that aligns with your aspirations and risk appetite. Embrace a bolder approach if you're young. Stocks and equity mutual funds can be your allies in wealth creation. Investing is a marathon, not a sprint. Patience and a long-term perspective are your guiding stars. Your investment strategy should evolve with your life stages. Nearing retirement, focus on stability and regular income. Bonds and fixed deposits provide security during your golden years. Diversification is the bedrock of a resilient portfolio. Imagine your investments as a symphony orchestra, each instrument playing a distinct role. Diversifying across asset classes minimizes risk and maximizes returns. Seek guidance from a financial advisor. A financial advisor can help you navigate the market and make informed decisions. Investing is about empowering yourself and securing your financial well-being. Take the first step, make informed choices, and watch your financial dreams turn into reality.